Hello everyone, welcome back. In this fraud analytics series, today we'll be covering a critical topic: 3DS versus non-3DS transactions and understanding the liabilities involved. Specifically, we'll discuss who is liable for any fraud that occurs during these transactions. So, what is a 3DS transaction? You may have heard the term 3DS, but what does it actually mean? This method requires the cardholder to verify their identity with the card issuer during the payment process. This is typically done by asking for a password or sending a one-time code to the cardholder's phone. Common examples of 3DS include Verified by Visa, MasterCard Secure Code, and American Express SafeKey. Using 3DS reduces the risk of fraud and increases protection for both the seller, which is the merchant, and the cardholder, which is the customer. Now, let's talk about non-3DS transactions. In this method, the additional verification step is skipped and the money is immediately withdrawn from the customer's account. However, this puts the customer at a higher risk of exposure to hackers and online fraud. When fraud occurs, the big question is who is liable for the lost funds? The main difference between 3DS and non-3DS transactions lies in the liability. In the case of a 3DS transaction, the liability for the fraudulent transaction shifts from the merchant to the card issuer. However, in non-3DS transactions, the merchant remains liable for the fraud. That's all for today's discussion. I hope you now have a clearer understanding of the difference between 3DS and non-3DS transactions and which card or payment process you might want to choose in the future. If you found this helpful, please subscribe, like and share the channel. It takes a lot of effort to create these videos, and your support gives us the strength to keep making more. Thank you for watching.